Hey.
Okay, go ahead. I got it. American Mind and Emotion. So give it to me. What do you got, AME?
One, I'm glad you're here talking with us. I've actually been talking to a lot of people recently about the SEC, and I was like, I think that we should make a bigger effort to be part of the process. So one thing about blockchain is that I think that there's kind of two different ways of doing accounting in the world. And one is a centralized way of accounting where you have to trust a third party accountant that's supposed to be neutral, which in an ideal world would be great if that worked. And then there's a different distributed ledger where there's like kind of a collective accounting process. And I see definite problems with each side of that each side can be exploited in different ways. But I do see a really big need to have more transparency in what happens in the stock market, like the fact that stocks might be shorted multiple times, or that, I did a comparison between different stocks and how many failures to deliver. And certain stocks, like Apple had a failure to deliver rate of 0.3% versus a different stock that might be considered a meme stock, which would have like a 20% fail rate. And so it's like kind of hard for the community at large of retail investors to trust that FINRA and the SEC are doing their job if there's like such a big discrepancy in, like, no one knows how many short positions are out there, what people's short positions, even what swap positions they have. And so I've just seen a lot of people that have kind of lost faith that the system actually works.
That's a great point about the failure to deliver the large. I think it's a good investor protection. I want to hear Josh's point of view on this because he's an economist who's also worked at the SEC, and we're lucky to have him on the space. I think that I mean, Josh, those are powerful data points. I know that as a former SEC enforcement staffer, I was presented with those types of data points sometimes, and I knew, and I was work with FINRA or work with the New York Stock Exchange to analyze them, but the case would just sometimes be too hard to really find the intent I needed to put together the evidence in a market manipulation case. Were you ever approached along those lines, or did you do any work there? What do you make of these data points when they seem to be, again, they like so jarring?
Yeah,
Um,
yeah, I think AME makes a great point. I don't understand, and I said this when I was at the SEC, why are short sales not reported in real time the same as going long? If we have tickers of people that are going long on a stock, I don't understand why we give them 2 weeks to report short sales. I realize that short sellers play an important role, and this is something that I have to talk a lot with students. I've engaged with people on Twitter about this. There's a paper in the late 70s, Miller, 1977, that says, look, in markets where short selling is limited, stock prices tend to drift too highly. And then if you just sort of invest blindly, your returns are going to suffer because you haven't impounded those negative views. But I think to AME's point, we've had these markets, at least since 2020, where retail is now 25% of trading. And when you start losing faith in that certain stocks have higher failures to deliver, or it seems to be something is not fair. Even the Robinhood debacle around GameStop was something that I think a lot of people lost trust and sort of thought this was skewed towards the large institutions. That's when I get scared because I don't want people to leave the stock market. The stock market is an enormously fantastic place to build wealth, generational wealth. If you leave that, you're really missing out on something in the future. And so I would like to see short selling, reported more frequently. One thing I get asked a lot is a lot of people throw out accusations about stocks being shorted nakedly. And for those of you on the call that don't know what that is, that means that there's a requirement that you have to locate shares when you short it to borrow. So if I'm going to short a stock, let's say I'm going to short Apple, John is long Apple, I borrow shares from his account, I sell it to AME, then I receive a cash flow for whatever the price is today, and then later I buy it back in the market and I put that back into John's account. John doesn't know I borrowed the stock from him, and so somebody else can borrow those shares that I sold to AME, and so a stock can be shorted multiple times and it can have short interest that drifts above 100%. That doesn't mean that there's naked shorting. It just means that we don't know that the stock's been shorted more than once. And so that's something I would like to see the SEC track more closely and also provide maybe even better disclosure on those means.
And see, that's actually something that I think blockchain technology could help. And I realize that there's lots of flaws in the idea of blockchain and it's hard to trust anyone. But the idea is that it's actually you can build a contract into it, right? So that maybe there should be something where you have a share and each share could only be borrowed once, right? Because like if the rule is that they only have to have a reasonable expectation that they could locate a share, but like as I've been kind of going through history and I've looked at inflation, I noticed that when Warren Buffett bought the trading stamps company, that it was inflation went up really high and he could go sell all these trading stamps and then buy appreciating assets. Meanwhile, he wouldn't have to pay it back for a whole year. And in that time, inflation was 10%. And so you had a guaranteed 10% return just exploiting inflation. And so I just think there's just like these inflammatory processes that kind of periodically get exploited in different ways. And I think that when you naked short a company, you know, a lot of the trading algorithms use momentum, right? And so they can break momentum, and knowing that if they don't have to pay it back till 35 days later, that the price is going to be lower. They're manipulating the market on purpose. And even if they keep passing the buck, well, then at least if they had to pay back the same amount later, by the time they pay it back a year, 2 years, or 3 years later, if they keep kicking the can, inflation has made that debt that they have to pay back less.
Well, yeah, I mean, the thing, it's hard for me. I appreciate that these are all great points. I don't think anyone should ever invest in a meme stock. Josh, do you agree with me? Because there's all kinds of problems. You can make allegations like that based on the data that you see, and sort of conclude that there's chicanery going on or there's profiteering going on that's even more egregious than whatever traditional profiteering is going on. But I just think you should stay away from all this stuff.
Well, consider something a meme stock, right? Because like if you actually like look at like the classical like way that you would evaluate a company, companies like Apple or Nvidia are like very inflated, right? Whereas you have a company where back all in 2014, Mark Vaden said the mother baby market is a really great market. And then you have a company like Bed Bath and Beyond who has a subsidiary called Buy Buy Baby, which is, you know, kind of the go-to place. And they have intellectual property as far as patents for registries, baby registries and wedding registries. And so to be able to pick that up for pennies on the dollar, doesn't that seem like a good idea, especially if you can add in a robust e-commerce solution, right?
Yeah,
So
if you're looking at the details and fundamentals of a company and making your decision like that, and Bye Bye Baby is a funny example because when our kids were little, my wife used to call it Bye Bye Money. So I get it, but I think, and so if you're doing a traditional analysis of a company and not doing it based on someone who's just chasing a stock on social media, and it's difficult to identify the difference between the two. Josh, what do you think? You're probably much better qualified to answer that question than I am.
Yeah, so we've been trying to sort this out in the academic literature. I think he's questioned on what defines a meme stock. You know, there are retail popular stocks, that retail investors want to invest in for fundamental reasons. We believe, let's just say NVIDIA, Chat GPT, something we're all familiar with now, and NVIDIA makes, a product that closely aligns with AI. Investing in NVIDIA is different than what we saw where GameStop's market cap went from 5 billion to 22 billion in 2 days. And there was no change in the underlying business model. That was a gamma squeeze where retail investors got together, coordinated, which we didn't think was possible before social media. And that buying pressure squeezed out the short sellers and those selling options on the stock such that, it put upward price pressure where there was no change in the fundamental underlying, business. There wasn't, they didn't pivot to a different business. They didn't have some contract that came in. So academia is trying to identify, what is a meme stock? I think the simplest definition is a stock whose price is deviated pretty substantially from its fundamental value or even potential value, and it's popular with retail investors. I think that's probably the simplest definition.
So I think that that's a good point. And, for me, within the communities I frequent, it is people are allured by the idea of a short squeeze. But I think there is something to be said about deep value, right? And it seems kind of obvious. Like one thing they always say about financial advice is past performance isn't predictive of future performance, right? And that's exactly, you look at someone like Ryan Cohen, and I think that he had the idea for Bye Bye Baby back when in 2014 when Mark Vaden said that it was a gold mine of a market, right? But they noticed at that time that PetSmart was having a hard time keeping up with the e-commerce world. And so they filled that market first with Chewy, right? And there was a market for e-commerce, that there was this inefficiency in the market, and that he was able to fill it. Well, now you look at something like the gaming world, which we know is expanding, and you look at like Twitch and Kick, and it's a total addressable market of like $200 billion. And when you think about what platform someone would go to, when GameStop finally has their streaming service, it will probably take at least half of that total addressable market. And so at that point in the future, we'll look back and say, well, it was obvious that was a good choice. But in the moment, if someone is using the past to dictate the future and say, oh, are just these little retail stores that are selling Xboxes, is that going to be this huge company? It seems kind of unrealistic. But when you think about like the actual vision, right, which usually they write it in their letter to the board, and when those letters aren't even taken seriously or factored into the account, right? It seems kind of odd that people would pick and choose what visions they look at as being viable and which ones they don't.
Yeah, again, I sort of go back, Josh, to when the first meme stock was probably iOmega, which was an external hard drive in the early '90s, and that stock went there were these iOmegans who were completely devoted to them, and I had an iOmega external hard drive because at the time, there was no such. You couldn't get like it was. It was actually only a gigabyte, but that was amazing that I had that. So I get it. I think we're getting into a discussion now of because when you talk about market share, potential market share, it depends on your theory of investing, on how you approach whatever analytical model you use, whether it's based on the data of the stock's movements or whether it's based on the fundamentals of the company, whether you believe in the vision, whether you believe in management, whether it's just the lesson that I would give to everyone is that you should really just do your homework when you invest, talk to people you trust, and don't listen to anyone on social media. Even if you think they're worth something, make sure that you've really researched them as well. I think it's important to talk to, like, treat your investments like you would picking a doctor for heart surgery. That's how I would do it. And I think that I've been told, hey, that's an ancient way. Okay, boomer, stop thinking that way because that's not what young people want. But I do think that's the safest way. And maybe my age sort of gives that away. But at this point, I think we've been in this space for about, I don't know, maybe 4 or 5 hours or something.
Real quick, I actually am a medical doctor, by the way, which is kind of funny that you bring up that example.
Well, make it sure we're going to wrap it up, Doc.
Okay.
But I'm
Yeah.
so glad you're on the space because that side of trading, the psychology of it, must really fascinate you exponentially.
It does, and I realize people look at different things. And for me, I look at like what is the price say about, like, the price movement say about the thesis of the stock. And I wasn't in GameStop at the time, right? And but the thesis of the price movement was that it was going to bankruptcy. And so we can actually definitively see now that they're basically a cash flow neutral company, even though they haven't yet realized the ultimate vision, right? That they actually already debunked that narrative, right? And so yes, there was some things that happened in the market, but that you can say, oh, it's a gamma ramp and it's this, but the fact is it probably was shorted more than 100%, right? And so I just think that we should be careful about classifying things as meme stocks. And I would love to be part of that for free. I'd volunteer however much time to go to the SEC and talk to you guys more.
Yeah, yeah. All right. Well, look, your perspective is worth a lot, and same with Josh's. So I think we're lucky to have both of you. Josh, especially, I want to thank you because you didn't sign up for this when you logged in on your Sunday afternoon. But having someone like you has been amazing, and your students at Vanderbilt are lucky to have you as well. So thanks for participating. And I do these spaces every once in a while, just when I feel like it, and then I don't advertise them or anything. I don't have anything to gain. I'm not trying to make any money. I'm not trying to get any clients. I don't have any clients in the crypto space or anything. I just really enjoy it. I think it's really interesting to hear from everybody coming from everywhere, and you never know who's going to join your space. So, thank you, everybody. Have a great Sunday afternoon. Check out, I think the U.S. Open finals are on now. If you feel like watching that, or football season's going on now, there's a lot of good stuff. So enjoy some time. Hopefully, you're having with your families. There's a bunch of people I didn't get to. That's never happened before. So I'm sorry to all of you guys that I didn't get to. Next time I'll try. I'll try to remember everybody. So have a great day, and thanks everybody. Thanks especially Josh, and thanks AME as well. Take care now, everyone.
Thank you.
Bye bye.